Welcome to this week's edition of the Pete Mezzetti Show. This evening's topic is a general overview of mortgages and what you should do when you need a mortgage, and a lot of mortgage background information. With me to discuss this evening's topic is mortgage expert Bob Bradley. Bob.
Peter, good to see you.
How are you, buddy?
Good, buddy.
Good. So I was wondering, what are some basics of mortgages?
Well, in this environment, Pete, there's a lot more to know about mortgages, a lot of things you do need to know, but some of the basics are really one of the most important things. It would be your credit score. Mm-hmm. And what is your credit score? Credit scoring system goes from a 300 to an 850 for most bureaus, and 300 is bad and 850 is great. So like anything else in life, there's kind of a bell curve of scores, and what you want to do is be in the upper part of that curve. So if you can be 700 or better, you'll find more products and programs available to you. Other things, it comes down to really calculation of your debt-to-income ratio, and that's simply a calculation of how much money comes in versus how much goes out.
Right.
Very important in our business because there are certain limitations for debt-to-income ratios. The other things are things like, what is your loan to value if you're refinancing, or what kind of a down payment do you have if you're purchasing a home? Okay. A lot of different programs available. I mean, the old conventional programs where you put 20% down, certainly those are still available, and other products are available. There are a lot of government programs to help people that are upside down in their houses, or other programs that are available are things like USDA programs where it only requires 0%, or FHA products. VA loans are very popular now, so there's a lot going on.
What are the differences in some of the different types of loans?
Well, really it comes down to requirements and overlays of products. Okay. You can only get a VA loan if you are a veteran. Right. You can really only get an FHA loan, so there's a little nuance to it, but typically those are designed for first-time home buyers. USDA loans, they are very specific in terms of income qualifications and property qualifications. They're designed for rural areas, so you won't see a USDA loan, also known as an RD, or Rural Development Loan, excuse me, in a city. So
you'll see them more in the country.
You'll see them in the country, yeah. And again, there are income limitations that are associated with that too. So, again, many nuances. It's hard to, in a few minutes, explain all the nuances associated with any one of the programs. But very interesting. A very interesting time now in the mortgage industry. I think things have changed a lot. 5-10 years ago, there were a lot more programs, a lot of what they refer to as subprime loans available. Okay. You don't really see those anymore at all. No. Very specific markets for those, but predominantly you're looking at conventional type mortgages.
And what is a conventional type mortgage for those?
Conventional, and true definition of a conventional mortgage would be something with 5% or up to 20% down. Okay. And those have limitations in terms of the total mortgage amount. And the jumbo limitation is $417,000.
Really? Hmm? Oh my God.
Yeah.
Holy.
Interesting.
Very interesting. Very interesting. Now, what does the word mortgage mean?
Well, the true meaning of it is actually a French word. It means dead pledge, which essentially, if you think about it, most mortgages are 30 years. And after that, as you're paying through the mortgage becomes dead. So it is a pledge of money, essentially, to pay back over a period of time. All right. And the collateral for that mortgage, or associated with that mortgage, would have been the house. Okay. In most cases.
Now, are all mortgages typically 30 years, or are there?
No. I mean, there are lots of different products. I mean, the traditional mortgage you'll see has become a 30-year product, but there are 40-year products. In some other countries, there are 100-year products, but typically you'll see a 30-year amortization. Okay. And then there might be, another twist to that because you can have an adjustable rate known as an ARM product, adjustable rate mortgage. Now those can be for 1 year, 3 years, 5 years, 7 years, up to 10 years. but generally speaking, the amortization period is 30 years.
Really?
Generally what you'll say.
Normally what you'll say.
Normally.
Exactly.
As I said, a lot of nuances in the business now, a lot of different changes, a lot of details to the everyday inner workings, but
Exactly.
typically that's what you'll see.
Off the top of your head, what are the couple of the nuances?
Well, again, just the overlays of different products and investors. I mean, there's certain things where some of the guideline things that used to be more guideline oriented have become hard and fast rules. It used to be more variability with a debt to income ratio, for instance. I mean, you used to be able to go up to 64.9% debt to income, which would basically say that 65 cents, roughly, of every dollar that you were making could be committed toward your mortgage and other expenses that show on your credit. The investor overlays on that have dropped that to 50 in some cases, 45 in other cases, and after the first of the year, you will not be able to go beyond a debt to income of 43%.
Really?
Mm-hmm.
Why is that?
Well, it's probably partly to take some of the responsibility back into the market. I mean, some of the programs allowed for people maybe to get over the limits that they should. And maybe, you know, the old Fannie Mae guideline was what we call 28 and 36, which was considered back end and front end and back end ratio. 28%, 28 cents of every dollar that you made should go towards your house expense. Plus, then 36 would mean house plus everything else. Again, they extended that to go to 64.9 once upon a time. They're bringing that back to the 43%, which really does make more sense. It's, you know, you don't want people to spend beyond their means.
Right, exactly.
So.
And is that going to, you said that's going to change fairly soon with the 60?
The change on, excuse me, January 10th, they're going to make some changes to it. It's called QM and QRM, qualified mortgages, essentially qualified residential mortgages. And what it does is just going to enhance some of the guidelines and limitations to the mortgages.
Very interesting.
Very interesting.
Exactly. I'm sure very time consuming for people like you and the people in your industry.
Yes. Well, you know, it goes through me, and then it goes through an underwriter, and it goes through a processor, it goes through a processor, and then to an underwriter, it goes to an investor. So there's a lot of checks and balances to make sure that, you know, we're being responsible in the marketplace.
I guess one of the other questions I have is, what do people need to know?
Yeah, you know, people really just need to know how to get from point A to point B. And, you know, whether it's me or many other, you know, qualified mortgage people, it's really an educational process. You start at the beginning, you kind of lay out the overview of your situation. You talk about the job, the income, the amount that you have for a down payment. The equity that you have in the property, what kind of property it is. Are you looking at an investment property, a second home? Again, back to the USDA, VA, FHA loans. It really is just more than anything, it's really an educational process. That's what's important about this business. There's a lot of, you know, you'll see a lot of things in the paper and on TV and, you know, today only, and that's not what you want. You really want somebody that can bring you through and explain the whole thing. One of my little phrases, you've heard me say it before, it's not magic, it's just math. And understanding the math of how to get from point A to point B is critical.
Exactly. And it's not easy.
It's not easy, but when you have somebody that's in the business that does it all the time, that sees the changes in products and programs with a level of experience, it makes a lot more sense.
Exactly. And what are the mortgage rates, and have they ever been this low?
Mortgage rates now are phenomenal. Personally, I started in the business in 15-something years ago. And when I started, rates were hovering around 9%. And right now, they're for a 30-year fixed. You can find lower, and you will see different things in the paper. Where it's more of a come on and/or just not completely informative. But a real 30-year fixed right now is about 4.25. So that translates to roughly $5 for every $1,000 that you borrowed. So if you borrowed $100,000, move the decimal places, that means your principal and interest payment would be about $500.
Okay.
So have they ever been this low? Yeah, they've been this low. They're still phenomenal. They were a little bit lower a few months back in early 2012, but they are still phenomenal.
And what are the typical closing costs?
Typical closing costs, again, it's an informed process and an educational process. The closing costs that are associated with any mortgage, whether it be a purchase or a refinance, you're going to have costs that are associated with the bank, whether it be a processing cost, an underwriting cost,
Right.
and any kind of administrative fee. You also have legal fees, and that will be the attorney that's involved in it.
Right.
They will also do a title search. You will have title insurance. Title insurance is a function of the loan amount.
Okay.
Roughly speaking, title insurance is about 3.5 cents per thousand. So on a $100,000 loan, that'd be about $350. As you can see, if the loan amount's $400,000, it can be substantial.
Exactly.
The town charges a fee to record the note and the deed.
Of course.
And there are others. There can be conveyance fees, et cetera, if you're on the sale side.
Yep.
But that's typical. What do those add up to? It depends on the loan amount, again, for the title insurance, but roughly speaking, true closing costs should be around $3,000 when you break it all down.
Exactly.
Many times you'll see, we've got a $495 only closing cost.
Exactly.
That may be specific to just the company, but there are other functions that are integral to the closing process.
Exactly. And it's probably a long, drawn-out process that takes a lot of time.
It takes some time. It really depends. It depends on how complete the package is. If you're starting from, square one and it's a process of gathering information, income information and credit information.
You know what? We'll talk about information when we come back.
Alrighty.
We'll be right back after a short break.
Plant inspiration. Provide youth with the creative tools and skills to cultivate it. And you'll be amazed at what can grow. Adobe Youth Voices in the Peapod Foundation. Learn more at plantandinspire.org.
Bicycles are vehicles and have the same rights and responsibilities of other road users. We all know someone who rides a bike. Maybe you bike too. Obey all traffic laws and be predictable. Always drive your bike with traffic. Look ahead for potential hazards. Only pass a bicycle when it's safe to do so. Slow down and give 3 feet of space. When we all drive safely and are considerate of others, it's easy to share the road. This message brought to you by the Connecticut Bike Coalition, ConnDOT, and this station.
And welcome back to this week's edition of the Pete Mezzetti Show. And with me again is local mortgage expert Bob Bradley. Bob, welcome back.
Thanks, Peter.
No problem, buddy. No problem. So before we went to the break, we started talking about closing costs, and I wanted to maybe finish up on the typical closing costs what we didn't cover before we went to the break.
Well, again, Pete, it's I explain it as kind of we're talking about a mortgage closing. Let's just focus on a purchase for right now.
Sure.
Okay. And I usually explain that it's kind of a 4-pronged approach to our grouping of closing costs.
Okay.
You're going to have your down payment, and whatever that is. Might be $10,000, might be $100,000. So that's one grouping. So your down payment.
Okay.
Then you have your true closing costs. And again, those should be around $3,000 for bank fees, any kind of administrative underwriting fees.
Yep.
You're going to have an appraisal fee, and on a single-family home, that's usually $375. Okay. You'll have attorney fees, and depends on the attorney, depends on the amount of work. On a purchase, it's usually a little more work for an attorney. So those could be, you've $750. Again, by the time you roll all those together, it should be about $3,000. So there's another bucket, true closing costs.
Right.
Most people escrow for their taxes and for their insurance.
Right.
And escrow is just a fancy word for the bank holding a savings account to collect those. So when that installment comes due, they will pay them.
Right.
So at a closing, most towns in Connecticut, not all, but most, pay their taxes, or you pay their taxes, every 6 months. On a typical closing, you're either repaying the seller who's prepaid into those taxes,
Right.
or you're collecting enough to have into the escrow account. Typically, I say on a purchase, you want to collect, they will collect about 8 months worth of tax escrows.
Okay.
And that depends on when those taxes come due. Again, most towns in Connecticut pay them in January and in July.
Right.
So there's a third bucket. So you have down payment, closing costs, prepaid items, which might also include your insurance premium if you haven't paid that separately.
All right.
And then you'll hear many times about points. Points used to be more popular. People would pay points, and if you want to buy down the rate, it makes sense to pay points.
Okay.
In this environment, with the rates the way they are, as low as they are, I generally don't advise for people to pay points.
No.
It just, it's not a tremendous bang for the buck. So,
All right.
So those would be the 4 categories:
Okay.
down payment, closing, prepaids, points.
Gotcha. All right. And I see rates in the paper and online. Are they real?
Many times, sometimes
Right.
they are. Many times that's, of course, that's an advertising medium.
Right.
And it's like anywhere else. I mean, grocery store or anything else might have a sale
Exactly.
to get you to pick up the phone or to come in or whatever.
Exactly.
Sometimes these rates are real, sometimes they're not. Sometimes they would be specific to someone else's situation other than yours.
Right.
I mean, if you have those are going to be designed to somebody that has a 700 plus score, has 20% down, stellar credit in every regard, longevity in their career and a specific job. Maybe you don't have that. Maybe you have a 640 score. Maybe you only have 3% or 3.5% down. Maybe you only have a few months or a short period of time in the job. Your situation is going to be different than what is going to be advertised and the lure of an advertised rate. But there's many companies, bankrate.com, they're a repository of information on the internet. They have rates from X, Y, and Z, A, B, and C company, many, many different companies. But again, the situations that are portrayed as part of that rate may or may not be specific to your case.
Okay. And I guess what are the basics of the mortgage industry?
Well, again, it comes down. I oftentimes what I do is when I'm sitting with somebody for the first time, I'll draw a circle, and I will break it down into a pie chart. And the basics of a mortgage really come down to the income, the assets, and the credit.
Right.
All 3 are important. You have to have enough income to support the loan. You have to have an asset either in the down payment and or in the equity. And you have to have a good credit score. Again, it's really an educational process, as I said in the first segment. It's really going through and understanding your specific loan, the specific details of the product that you're looking at. And people, that's what you should do. You should get an education. It's not like picking a pair of shoes, if you will. I mean, the mortgage really has to fit the person, fit the profile.
Exactly. Now, hypothetically speaking, what if your credit score is not really good? Will they automatically decline you for a mortgage?
Well, if you have less than a 640 score now, the answer is pretty much yes.
Okay.
Anybody that's good in the business will help you get that score up. There are many products and models that we use. And I can look at a credit score or a credit profile, and I can say, pay this credit card down, clear up this collection account. Anybody that's worth their salt in this business will tell you the same thing. They'll explain to you how it works. They will focus on the things that need to be fixed to position you to get the best mortgage you can. Can you get a mortgage with less than stellar credit? Yeah, you can. The rate will be affected slightly by the fact that the score is, again, a 640 versus a 740.
Right.
But you can. But again, I think the most important thing is really, even if you're not looking for a mortgage yet, is talking to somebody to get an understanding of what you have to do to educate yourself in the process. Then you're armed with information and you can really get yourself, better qualified to get a better mortgage.
Now, typically, how long does the process take?
And, in a perfect world, somebody with perfect credit, you could close in 2 weeks.
Okay.
Generally speaking, on a purchase, there's a few more nuances with a purchase because you've got people selling, you've got an appraisal that has to happen, they're looking for a house. I would say that generally takes 5 to 6 weeks.
Wow.
But, the approval process, you can get more information in 15 minutes by sitting with somebody,
Right.
a mortgage banker or a mortgage broker, a bank, a credit union, whatever. You get a lot of information in 15, you should be able to get a lot of information in 15 minutes.
Exactly. And I guess there's so many different types of mortgages. Why should somebody choose one over another?
Again, it's going to be specific to your case. Somebody might resist, for instance, an adjustable rate. They might say, I don't want to do adjustable. I just want to know what my payment is for 30 years.
Right.
But let's say they work for, I don't know, XYZ company, and that they're here on a specific time assignment. They're going to be here for 5 years, they're going to be transferred.
Right.
Why wouldn't they consider an adjustable rate that has a little bit better rate, is fixed for, like, again, 5 years or 7 years,
Right.
if they know that they're only going to be here for that period of time?
Right.
They should take advantage of that.
They should.
And again, it's an education in order so they can take advantage of it.
It is. And I guess what are the different types of mortgages? I hear about fixed mortgages, adjustable mortgages.
Yeah, well, we kind of covered some of those, but again, there are a wide variety of them, whether it be a fixed mortgage, an adjustable mortgage, a jumbo mortgage, a combination of an interest-only and an adjustable rate mortgage. And again, each one is going to be specific to the individual. So to just say that, it's never a one mortgage fits all. Never.
No?
No.
Not like a pair of shoes?
Not like a pair of shoes. No. Really, it is custom fit for each person.
Exactly. And that customization usually takes some time. You can't do that with a person in one sitting or one meeting.
Well, you can get somebody, again, in my industry, my business, that's good at what they do. You can get a very good idea in a short period of time as to what the better way to go is. Oftentimes there are many answers. I had one client recently, and I was going through it, and I said, "There's not one answer for you. You have many, many, many different options."
Right.
And then I will suggest, or somebody else might suggest, this is why I would do this over that. But in many cases, there's a lot of different answers.
Really?
So, yeah. Again, the most important thing of this whole segment is really gathering information and getting an education from somebody that does it every day.
Okay. And we've got a few more minutes before we say goodnight. What else would you like to tell? What else would you like to educate our viewers and our listeners with?
Well, again, I think one of the most important things is that you want to speak with somebody reputable.
Right.
There are many local companies. There are many, many, many good people that are in the industry. It becomes kind of a personal feel. It's like any other relationship. Whether you go to a mechanic or a doctor or a dentist, there's a feel that you get with that person.
Right.
And feeling comfortable with the fact that you're going to get accurate information and your questions are going to be answered in a timely fashion. That's key. That really is key.
And now, how you said timely fashion, how long does that usually take?
Again, somebody
It depends. Depends on your credit score.
Well, it depends, but somebody that's in the industry can, a half an hour of sitting with somebody can really shed a lot of light on your situation.
Exactly.
So.
Yeah, exactly. And before we say goodnight, what else would you like to, any other words of wisdom?
No, again, do your homework. Do a little checking into the person, reputation, referral. You certainly can go with the online things and call somebody and somewhere in the middle of the country, and they're maybe good as well. But a local reputation and a referral partner is really key.
Okay.
I mean, most people in my business look for that customer for life kind of thing, and it's important. It's important.
Exactly.
You want to know who you're getting your mortgage from.
Exactly.
And that you're well taken care of.
Exactly. It's very important. Well, Bob Bradley, local mortgage expert, thanks a lot for stopping by.
Peter, thank you.
We'll see you soon.
All right. Yes, sir.
All right.
All right.
On behalf of local mortgage expert Bob Bradley, I'm Pete Mezzetti. We'll see you next time.